Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast, where our mission is to build and maintain massive amounts of cash flow through income-producing real estate investments. And our guest for this week's show is hospitality expert and managing director of hospitality investments for Avistone, Charlie Muller. Now, Charlie has a broad-based background in hotel and recreational real estate with over 38 years of experience in operations, capital planning, acquisitions, development, asset management, and dispositions. At Avistone, Charlie will be leveraging his senior leadership experience and network developed in the acquisition of over 75 hotels valued at $3.1 billion, development or redevelopment of 19 hotels at $1.1 billion, and the acquisition of over 120 recreational properties valued at $2.4 billion, and then asset management practices for over 200 hotels and recreational properties. And so, guys, without further ado, I'd like to welcome our guest for today's show, Charlie Muller. Charlie, how you doing today?
Doing great, Kevin. Thanks for the opportunity.
Yeah, thanks for being here. I was really excited to have you on the show here. And hospitality is it's that sector. It's one of the sectors that was the sector that was probably the hardest hit, real estate sector that was hardest hit during COVID. A few others, got some bumps and bruises along the way, but hospitality, unfortunately, with people not traveling for business, for pleasure, hotel is just, they had a very difficult time. And I know that Avistone is, for the most part, an industrial investment group. Charlie, you've come on board to essentially help them expand and take advantage maybe of some opportunities here in the hospitality space. And so very excited to talk about that. Excited to talk about the state of the state of hospitality today, what your forecasts are for the future, and ultimately everything in between. But before we go down that rabbit hole there, Charlie, what I'd love for you to do, if you would, is I gave you a really brief introduction there. I know your background's much more expansive, and so maybe if you could tell us a little bit more about yourself, your background, and how you found your way into the hospitality space.
I appreciate that. It is a labor of love for me to be in the lodging and hospitality sector. It's everything I've ever done from a career standpoint. I started washing dishes when I was a young kid, before I was even 16. A very short but quick story I love to tell. One of my older sisters, of which I have three, she was a waitress at a fun little restaurant, Lum's, back in the Northeast. I'm a Connecticut boy originally. And she would come home with $35 in her pocket as a waitress and have a great time. And I just always thought that was engaging and fascinating. I tend to be a very social guy. So started working in the restaurants and really enjoyed that, became a short order cook, and then continued to find my way, whether it be towards a career or just towards an entertaining job, staying in the food and beverage side of the industry, and morphed into working at a Howard Johnson's along a highway in Connecticut. Got a chance to go to work behind the front desk at the lodge that was attached to it, small 124 room Howard Johnson's Motor Lodge, of which there are very, very few of those nowadays, but enjoyed that. And then subsequently just started working my way up in the business by virtue of job experience, trying to make it after spending a short stint in college, and then realizing that college was going to further that, and went and had the great fortune of studying at Cornell University School of Hotel Administration, and created an incredible network, and then have subsequently moved on to this, now close to 40-year career since being out of school in the early 1980s. And it's all I've done, Kevin, and it's a passion for me. It's quite of a joy for me.
Yeah, well, I appreciate that. And Avistone. So Avistone is predominantly an industrial investment group. They are veering into the hospitality side of things. So maybe tell us a little bit more about Avistone, kind of their background, and then really what was the catalyst of opening up this new division of the company to acquire hospitality investments.
Absolutely. The company was founded about 8 years ago, and has, through the good fortune of two various investment funds in the industrial side, has acquired over 24 industrial parks with close to 4 million square feet of space, of which they've completed round trips or acquiring, improving, and selling those properties on 20 of those, and have earned a very good average annual distribution to its investors, a strong rate of return to its investors. Very similar to others that have experience on the real estate side. They saw what's played out in the hospitality industry over this last year, and they thought good inflection point in the industry in which to come in and start a new fund and invest again, to create opportunistic investments for shareholders, for its customer base. And I was fortunate enough to connect with them and share my thoughts on the industry. And now we have aligned, and I'm looking forward to taking the infrastructure that this company has and has developed over these last 8 years and move it into a new sector.
Yeah, that's exciting. You know, back when this pandemic first started, and I forget the exact date. I think not when it started, but when I had a guest on the show. I had Brad Rahinsky of Hotel Equities, the CEO of Hotel Equities, on the show, and I think it was probably towards the end of March. So I mean, COVID was pretty much in full swing across the country. It was, the hotels were actually a lot of the hotels were just shut down at that point in time. They hadn't even opened back up in a limited capacity. And it was interesting to garner his perspective of, number one, how they were weathering that current storm, and no one knew how long it was going to last. What were the talks like, behind the scenes, and even speaking to some of their hotels that had large banquet space and ballroom space. Were they talking about repurposing it possibly? Given that there's a chance it could be years before people have weddings again and have big formal executive meetings and things of that nature. And what I'd love to hear from you is, reflecting back again, we're a year past this, a little more than a year past this, from when it really, hit ground zero. What has really played out? Everyone can, look at the news, watch, whether it's CNN or Fox or whatever your choice might be, right? And get a high level general sense of maybe what's happening in the world, and they can kind of guess what's happening in hospitality because people aren't traveling for work and things of that nature. So we know that there's challenges there, but from your perspective, I mean, how bad did it really get? And where is it at today? What's the economic health look like today for the hospitality industry?
Yeah, it's been a very difficult year for the industry. Everyone knows what's played out over this last year with the pandemic. And certainly there's a lot of interest in its effect on the lodging industry, on the hospitality sector. Performance of the sector was significantly impacted by the immediate stay-at-home practices that were caused by health concerns and government restrictions. And frankly, it was the right thing to do. Everybody thought, well, let me say this a little bit differently. I don't think anybody believed it would have the length that it has had, which has just been amazing, to get to even a year now post the beginning of the pandemic and finally starting to see some pace of improvement or normalization coming back to the industry. We all believe that it might just be a near-term issue, but it's played out to be much longer than everybody thought. So resulting drop in value was tremendous. The industry lost in its key measure, which is RevPAR, revenue per available room. The industry lost 50, 60% over the course of the period of time. And we'd never done that before. I can remember the first time that the industry seemed to take a backward step in RevPAR was after 9/11. There's been a couple interesting inflection points in our business, and that certainly was one. There was another one through the great financial crisis. It's been interesting to see how everything has happened in our space, but values have dropped tremendously. Transactions fell off the map. Things that were planned to get done were canceled. Hotels were closed. The huge unfortunate part of it is the number of jobs that were lost in the industry. And, that just hits home for everybody right now. But this is an industry, as I mentioned earlier, very social industry. And it's a service industry. And a lot of people that are dedicated to this business are dedicated because they love to serve. And when you don't have that opportunity anymore, you ache for that. But we're now starting to see the sector come back. Unfortunately, Kevin, what the odd part of all of this is, we look at 2019 as being the year that had been, I think it was 7 or 8 years of successive growth in revenues and profit in our industry, starting way back from 2011 after the great financial crisis. And we've been at record levels, the industry has, of revenue and profits in 2019. So now we're measuring everything back to 2019. How are we getting back to the levels that the industry saw in 2019? Most recently, I think the most recent numbers were through the earlier part of May. We're getting closer on closing in on those 2019 levels. About 65% of the level of performance for 2019 the industry has reached now. It's probably closer to 70% over the passage, of just a couple of weeks. But it is a market by market business. We can talk about the industry globally. We can talk about it, just U.S. alone. We can talk about it across all different sectors, but it is a market by market business. So 166 U.S. markets are measured here. But good news is well more than half of them, 91 of those 166 U.S. markets, based on information provided by Smith Travel Research or STR, most recent RevPAR for the week was 80% or more of that achieved in 2019. So,
wow.
The industry is 67%, but over 55% of the markets, 80%. You still have some big urban markets like San Francisco, Chicago, New York, Boston that are struggling, and they'll continue to struggle for a while. But there has been a flight a little bit out of the urban environment, a flight more towards leisure travel, and there's a pent-up desire to be out in the marketplace. So we're seeing good signs of recovery. Travel confidence growing consistently over the last few months. The vaccination improvements and the recent lifting of mask mandates by the CDC just last week, I believe it was, tremendously benefit the sector. And so we're starting to see good signs. It will take a while for the industry to completely heal itself, but it's well on its way, fortunately.
That's great to hear. I mean, those are quite impressive numbers. I'm assuming there's just a lot of pent up demand. People are ready to get out and about, right? Sticking someone at home and telling them not to leave for a year. I mean, there's a few people that really enjoyed that, but the majority of us being social creatures, we couldn't wait to get the heck out and get back to some type of normalcy and take a drive and go to a different city or fly or what have you. And so,
no doubt.
So the question being, again, I'm very impressed with those numbers. That is quite the comeback. This time around, it's very different than maybe let's use the financial crisis 2008. As it might have affected hotels and their overall performance and how that stressed particular operators. How banks handled hotels that might have dropped below their performance metrics. This time around, it seemed like a majority of lenders were much more willing to work with borrowers, right? This is a global issue. This wasn't just a localized issue. This wasn't a operator being a bad operator. Maybe they were a bad operator prior to, but just speaking to in generalizations, a lot of banks and lenders are they're working with folks. I mean, they're kind of helping them through because everyone's in the same trouble, and nor do they want, billions of dollars of assets back on their books, right? That's just, they're not prepared for that either. And they saw how that played out after 2008 when they went down that path. So with that being said, where are the stress cracks? Where are the opportunities that ultimately your group is going to be seeking, right? You're an opportunistic fund. You're looking for those stress cracks, and where have they shown themselves to date, and where do you think they'll show themselves here in the coming year or two as you guys are in acquisition mode?
Interesting, if you look back to the start of the crisis and when it looked as though it was going to take a whole lot longer to come out of this than as mentioned, everybody had previously thought, there was a great expectation that distress in the industry would cause for a significant amount of loan defaults and a significant amount of activity on the lender side to take properties back. But you're absolutely right, Kevin. There's been a slow move to do that. Interesting. Probably 9-10 months ago, everybody thought the fall of 2020 was going to be a time when you're going to see a flood of distressed opportunities coming through lenders or owners requiring rescue capital. But a couple of things have affected that, right? You mentioned that the lenders don't really want these negative cash flowing properties to deal with on their own books, right? Also, it was understood that this is, just not really a secular change to the industry. It is a health crisis. It's not an economic crisis to the industry. But also there's a lot of, what's a good term? Let's just say, nobody really wanted to be on the lender side, the one that was foreclosing people in the middle of a tragic period of time.
From a PR perspective, is that what you mean?
Exactly.
Yeah.
Perfect. Exactly. And now, so you can talk to the broker community and again, dialing back 9 months ago, they were doing a tremendous amount of work on opinions of value and thoughts as it related to lenders and other, high-level investors about values and how you could put properties on the market, and it didn't materialize. We're starting to see that again now. There's a lot more activity, a lot more inquiries as to what values could happen. We're starting to see more properties come on the market, but not so much the distressed on the lender side. I'll speak to what's generally been in the market lately, but now we believe the industry, common belief is the fall of this year, you're going to start to see a lot of opportunities that are distressed through the lender side. So they're going to start to take properties back. You know, there's the kicking of the can, right, is a common phrase as to what's happened. There's been a lot of forbearance. There's been a lot of, ease on payment requirements. There's been a huge, something we've never seen in our industry, because I don't believe we've seen in our industry, is the ability for owners to use the reserves that are required by the lenders, that are required by the brands under which the hotels operate, to put back into improvement on property. Typically 3 to 4 to 5% a year of all hotel revenue goes into a reserve. It's interesting that the industry has been able to use those reserves. The lenders have said it's okay. The brands have said it's okay. The brands have eased some of their requirements for standards. But all of those things are going to contribute to this need for the industry to get recapitalized. A lot of the hotels need to be recapitalized. So there'll be rescue opportunities. There'll be opportunities to buy from lenders. We've seen more of, since we've been looking at this business and have been focused in the last few months, we've just seen more fatigued owners or reluctant owners that are selling assets currently. Right? Those are folks that had recently gotten into business or might have a couple few assets, and just say, this has been too much for me. I don't think I want to be in this business, or weren't fully capitalized or well capitalized. That's where the sale activity has been, but there'll be a widening of that come the fall.
Yeah, I could see that. I mean, you talk about the smaller operator that's got, a hotel or maybe even 10 hotels, right? That's still a smaller operator. If they've got 10 limited service hotels, all 10 got severely impacted. I mean, not many folks in that scenario would have enough liquidity to carry them through an entire year or more, because they're fully not back to pre-COVID levels. I mean, to carry through this, and I absolutely could see the fatigue. So I agree with you. I think there surely will be stress cracks there. How about the CMBS side of things? How have the servicers on the CMBS, I mean, very different world when you talk about CMBS versus your traditional lender, really don't have as much flexibility, on the CMBS loans. And I don't know how much of the, how much of the debt that's in the hospitality space is made up of CMBS loans. I have no idea what that number looks like. Do you know what percentages that make up percentages, or?
I don't think it does. I think it's grown to that as the industry's become more core. But I want to say it might be in that 5 to 10% range. But please don't quote me. I could be way off on that. So.
And have you seen any opportunities possibly getting kicked out of that from a debt distress standpoint on the CMBS side?
Yes, but again, it's been patient as other lenders have been patient across the board, right? It's interesting in CMBS debt, that the bondholders are still getting paid, right? But it's the issues is in those pools, the revenue is all being, a lot of the income coming in has been being forbeared. So there has to be a comeuppance of some sort there, right? Yeah. So I think that's going to probably accelerate a little more quicker than some of the regional banks will, because I think the regional banks will still have that PR concern over being looked at as being the bad guy and being the forecloser. I think you'll see more activity through the CMBS market, and whether that is the special services acting in favor of the bondholders and the pools and taking property back, or whether you see it in the borrowers looking for rescue capital to assist through that process.
Gotcha. So back to Avistone and the hospitality fund. What hotel types are you specifically looking for? Is it a wide range? What's that look like?
It is reasonably wide, but it's thoughtful. Okay, we want to be in premium branded properties. We like Marriott, Hilton, Hyatt, Intercontinental Hotel Group or IHG brands will generally be the focus. We'll focus on a good mix of, and mentioned, premium select service hotels or extended stay hotels.
Mm-hmm.
Also an interest in compact full service hotels. So smaller full service hotels that have a closer efficiency in the operating model to the select service hotels. We're not worried about independent or small boutique hotels. So it does have a wide swath, but then you look geographically, we're going to stay primary, secondary markets, urban, long-term is a great place. Short-term, there's a lot of concern, but we like urban, close-in, suburban. Truly, Kevin, we're looking for markets that have good metrics from the standpoint of business innovation, job growth, population growth. All right.
Mm-hmm.
So we think long-term, that's where the investors continue to follow. And for us, it certainly is about gaining cash flow early on, but it's also about making sure we're investing in the markets where others will continue to invest. So we have the opportunity to trade out of properties down.
Absolutely. What is a compact full service? I'm not familiar with that terminology. Can you give us an example of a brand that folks might know?
You bet. A lot of the brands, I would say more specifically Marriott, Hyatt, Hilton, some of the full service hotels have morphed down to 200 to 300 rooms.
Okay.
And don't have big expansive meeting space.
Gotcha.
So that's why we call it a compact full service hotel. Some of the bigger full service hotels with, 20, 30,000 square feet of meeting space, 3 or 4 food and beverage outlets. So the compact full service hotels has more of a hotel rooms type model. It might have a small restaurant, small lounge, and would have maybe, 4 to 5 to 6,000 square feet of meeting space.
Got it. How do you forecast the risk of, business travelers? Not sure exactly what percentage they make up of the hospitality space, but it's a big component of it, I'm sure. And one of the big shifts that, again, one could argue on both sides of the equation, right? Like I know that most folks became virtual, most positions became virtual. I think a lot of companies realize they could be as efficient. Other companies realize they couldn't be as efficient, and then some companies in the middle realize that some divisions could be efficient. Other ones they absolutely need to go back to the office, but really no one knows how that's going to play out in the long run. And ultimately, if it trends more towards folks telecommuting, working from home, then that will ultimately affect those hotels that are more the limited service. Or I don't know. I don't know the word. I typically stay at limited service hotels when I travel, just because it's easy and convenient. Right. But I'm assuming that full service gets equal amounts of business travelers as well. And so, how do you forecast that risk in the event things don't really go back to normal with the business traveler sector?
Kevin, it's funny that our industry certainly wasn't helped when not too long into the pandemic. And I might have said it might have been last summer sometime, or near the end of last summer, when Bill Gates comes out and says that 50% of business travel is going to disappear post-COVID. Right? That certainly doesn't help an industry that does rely a lot on business travel. And I often thought that was very interesting because Bill Gates is a very significant investor in several Four Seasons hotels and in the Four Seasons company himself. So, but nonetheless, our industry made up of, generally, easy way to categorize it, you're familiar with this, is leisure, right? And then individual business travel, and then group. So the leisure had a great summer last year. It slowed down a little bit come fall, but it still did reasonably well because, you had the challenge to any type of travel was when schools got to go in place, right? And then people weren't in school. So, you had a lot of kids staying at home, et cetera. That had a little bit of a appalling effect on the business. But, there's significant components and not a perfect mix, but let's just say the industry has a pretty good balance between group, business, and leisure. The long-term thinking is that group will take the longest to come back, even large group, but we're starting to see that. In fact, I was at a conference last week with well over 1,000 folks focused on hotel investing. So it was great to
That's
see
great. Yeah.
bigger groups coming back. Every conference that you or I or any of your listeners might have gone to in the last year has been pushed off. I will tell you, almost all of them are probably planning to come back. On the leisure side, a dramatic, challenging effect to social business, to wedding business, right? All the folks that were going to get married couldn't get married or adapted their change. So a lot of that business is thriving to come back. Travel, you mentioned it even earlier. Everyone just wants to get out and go places. Business will come back, right? I do think there'll be somewhat of a shift in that business. I don't think it'll be as strong as it was in the past, but people want to get out and do business with folks. I've heard several stories in the past when you're trying to pitch for business, right? You're going out there and you're afraid to travel, and you're talking to a company who says, look, I'm talking to three of you. And by the way, your competitor was just in the office. And you know what? I love the fact that he was in my office. So my business is going to him. There's going to be a lot of that will go on in the business. Or some people say, some people say, I don't want to travel. But when it starts to affect your impact of being with your clients, being with your customers, you're going to get back out and travel. So I don't think it's a secular change. I think it was a dramatic shift that will turn into a modest shift. But here's something new, something fun. There are new trends being foreseen in travel, right? With the advent of being able to work a little bit more remotely, or hybrid of remote and in office, there's this new sector that we call bleisure, or a combination of business and leisure. Mm-hmm. So that's when now you're going to go out to, a place you otherwise want to choose to go for the weekend, but you might go a couple of days earlier because you can work there too. So, that's interesting. I don't think it'll become a big thing, but it's a fun little term that we use in the industry right now. It's the growth of the bleisure sector.
That's great. Yeah. I love it. I love it.
But Kevin, it's just a big general thing, and no one was prepared or could have been prepared for what happened to demand and liquidity in our sector. But the industry's really responded and has worked harder than ever to become more efficient, and that's a very positive thing. Yeah,
no, that's great. And from a selfish standpoint, because I've traveled a good deal during the entirety of the pandemic. Not a lot, not as much as I had the years prior, but ultimately I did travel for both business and pleasure. And I'm going to miss some of the incredible rates that I was able to get at some of the nicer places. But again, just very selfish in nature from my standpoint. Yeah. But no, I'm just joking. But how about debt? How about, as you guys roll out this fund, are these going to be all cash acquisitions? Are you guys going to be placing debt? If you're going to be placing debt, what is the appetite now from a bank's perspective, lending on new acquisitions?
It's coming back. It's not as attractive as it was, obviously, just 2 years back, right? But there are a lot of debt funds out there, as there are investment funds that have aggregated capital and need to get that capital placed. So most of the debt that's available in the sector right now is coming from debt funds for acquisitions. And typically the loan to value is, let's say, roughly 65% or 60 to 70%. So we're targeting generally about 65% loan to value on our acquisitions. But we're seeing the pricing of that debt narrow almost every week. That's what the noise is in the marketplace. That's what we're hearing from folks that help secure that type of debt. It's getting better. You're starting to see balance sheet lenders look at lending again, but primarily only with very strong and key and important relationships, right? So as anybody that doesn't have a relationship, life company, regional bank, local banks, what have you, it'll be a little bit harder to get in the door. But that has to change, because that's what the business these folks are in. So it won't go away, but it'll be slower to come back. And then debt funds will have to be more responsive and start to lower their rates a little bit to compete with the balance sheet lenders.
Sure. No, absolutely. I appreciate you sharing that. I want to shift gears real quick, Charlie, if we could, before we work towards wrapping things up. And everyone, you've been in the business a long time. You've been at this for 38 years, and so you've done a lot of transactions. You've been in a lot of complex deals. a lot of times we tend to not necessarily forget. We sure that we never forget about them, but we tend to only talk about the, you know, the deal, the good deals, the ones that went, you know, as expected or exceeded expectations. But we never forget about the ones that gave us all the gray hairs, or we lost hair, or lost sleep at night, lost money, what have you. And so, is there a deal that, as I say those things, is there a deal that comes to mind that you feel is probably one of the more challenging or the most challenging deals that you've ever been involved in? And if so, you know, what was the deal? What were the challenges associated with it? And then ultimately, you know, if you do it over again, what would you have done differently?
Wow, great question, especially one to ask someone who is in the midst of a fund trying to raise capital. Have I ever done a bad deal? You know, Kevin, I've done a lot of great deals, and on average, we've been very, very successful. But I love the question. I do, truly do. And now,
we'd all be lying if we said that we never had a deal that didn't go as planned, right?
Yes. So. Yeah. So I would point towards in a prior life when I worked for a company that, you know, had built probably the second largest hotel REIT in the U.S. There was a portfolio deal that was done that was it was select service for the most part, right? But they were in a little bit of older assets, right? And I think in our business, that's what you've got to be more concerned about, is the age of an asset. And again, I mentioned this earlier, the ability to know that there's going to be an investor group to buy you out of that, right? But many times investment groups, when they get to be significant in size, they need to deploy significant capital, and they do it in larger portfolios. So that was perhaps, I would say, the rush to get dollars invested, even though you believed your underwriting was solid, was hindered by the age of the assets. That in our business, with, you know, good steady supply growth of typically long-term, you know, 1.5% to 2.5%, new generally outperforms old, or repositioned generally outperforms aged assets. So that was likely the bigger challenge I'd have. And learning from that is the desire to make sure we're positioned in properties that, you know, have the right amount of age on them, but also more importantly are constructed to be able to manage that age. So there's nothing wrong with buying an older asset. It just has to have good bones, right? That will always be able to be improved and looking like new. So, you know, I would say that the need to do larger transactions sometimes hinders, you know, sometimes requires you to look at portfolios that might not fully fit your knitting, right? But then on the flip side of that, you know, here's a great story. You know, I've been involved in transactions everywhere from a $4 million town place suite hotel in Maine to at what at that point was just under $400 million purchase of a 100-year-old hotel called the Hotel Del Coronado in San Diego.
Wow.
You know, Kevin, that's an old asset, right? But oh my gosh, it's well built and it's iconic. So there's always that balance. And that was a very, very successful investment for the firm I was with at that time. So that was wonderful.
Was that
but I hope that
early 1900s or late 1800s?
It was.
Okay.
It was.
Yeah.
Early 1900s. Yeah.
Wow. Yeah, that isn't that. As long as it's got good bones, right? That's all that matters.
Yeah.
Have you seen any type of trends? Go ahead. Sorry.
Yeah. So sorry. Just speaking back to that on you know, with our strategic fund that's really focused on opportunistic investing in the lodging sector, right? We are working at a measured pace to look at the market and to pick the right transactions. You know, we are. 50 million might seem like a lot of money to folks, but in the fund space, it's modest in size, right? So we don't have to go out and look at everything, although we looked at almost everything. It's been amazing, you know, just from the first quarter of this year, you know, where I was looking at 23 some odd hotels, you know, at now I'm looking at 87 some odd hotels. I mean, it's just amazing, and in the range that has changed over time, right? So it's been very, very impressive, but we're still being very disciplined and going at the right pace. So we're not forced to do large portfolios. We're not forced to make decisions just to get dollars invested. There's a good amount of stuff. I'm underwriting 20 properties right now. So
wow,
you know, we get to be selective, right? And of those 20, if we do 2, we'd be very, very happy.
Yeah, no, that's fantastic. Well, I'm excited for you guys. And Charlie, if you would, I know you just
Thanks.
shared a little bit of information about the fund, but maybe give a little bit more insight of the fund, how folks can learn more about it, and potentially even get involved. Again, I know it's a Reg D 506C, so it's only for accredited investors. But if there's anything else you'd like
Correct.
to share with it, please feel free.
Yeah, absolutely. At our website, avistone.com, you can find information on both our industrial fund and our strategic fund focused on opportunistic investing in the hotel sector. And then there's very easy paths in which to request information. PPM offering material will be sent out to you and someone will follow up with you. But the desire there is to provide investors a 9% preferred return before the sponsor starts to make any money through the investment cycle. But we believe we're going to be somewhere in the range of 15 to 18% returns to our investors. Cash flow in the hotel space is fascinating. It's got actually very good cash flow component to it. COVID is going to impact that a little bit in the near term, but current cash flows, once business starts to ramp up, gets to be better and better and better. And that's always been one of the hallmarks of investing in hotels on a levered basis. You generally get higher level cash flows out of investments. And Kevin, that's high single digits to low double digits once the industry is stabilized. So that becomes very beneficial. So we are in the midst of raising our $50 million fund. And as mentioned, we got a very robust pipeline, but with direction of the partners, with direction of our capital markets team, we're being very disciplined in what we look at and being very measured in our pace to do the right deals for our investors.
Well, absolutely. Fantastic, Charlie. Yeah, really appreciate your time here. It's been a lot of fun having you. Very informative. And again, folks, if you have an interest, go over to Avistone. You can learn more about this hospitality fund as well as any other funds that they've done here in the industrial space. And I'll put in the show notes as well. That way you can have a direct link to it. And Charlie, that's all we have today. I really appreciate it. Wishing you guys all the best as you roll out this fund and start you're purchasing hospitality properties, and excited to kind of follow the progress as you guys roll through these next couple of years, and crossing my fingers that everything gets back to normal here in the coming months, in the coming year. Hopefully not years, but hopefully in the coming year, we all get back to normal and we're traveling again and businesses are back to rocking and rolling, and things are good. So, but again, appreciate you coming here, and it's been a lot of fun having you.
Kevin, thanks so very much. Thanks for the opportunity and the interest.
Alrighty, guys, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. Take care.